Imagine waking up and realizing a three-digit number controls almost every financial decision in your life. It decides if you can buy a house, rent an apartment, lease a car, or get a job. It affects your interest rates, loan approvals, and sometimes how people judge you. This number is your credit score, and for most people, it's a mystery. Before 1956, credit had no number. Loan approval depended on a banker's judgment. Women often needed a male cosigner, minorities were frequently denied credit, and young people had little chance. Decisions were stored in paper files, making the system slow and unfair. In 1956, engineer Bill Fair and mathematician Earl Isaac asked, "What if we could predict credit risk with math?" They founded a company, used punch card computers to analyze borrowers, and by 1958, American Express adopted their model. By 1981, the first general-purpose FICO score was released, providing a standardized method to evaluate credit risk across the United States. By 1989, FICO scores were included in Equifax reports nationwide. This innovation made lending faster, more data-driven, and scalable. It reduced human bias, increased fairness, and transformed how banks and financial institutions made decisions. Millions of people were now assessed based on objective data rather than personal judgment, marking a major shift in finance and the way credit was distributed across society. By the 1990s, FICO scores were becoming widely adopted across U.S. lenders. In 1990, only a small fraction of banks used them, but by 1995, nearly half of all lenders relied on FICO, and by 2000, over 90% had integrated these scores into their decision-making. The rapid adoption coincided with the housing boom, as lenders needed fast, reliable ways to assess borrowers. Congress mandated free annual credit reports in 2003, increasing consumer awareness and understanding of credit. FICO 8, launched in 2008, improved fairness by ignoring small collections under $100. Later, FICO 10T introduced trended data to track monthly balances, providing a more accurate view of a borrower's financial habits. UltraFICO allowed consumers to boost their scores using positive banking behavior. Competitor Vantage Score appeared in 2006, offering alternatives to traditional FICO scoring. Yet, 90% of top lenders continued using FICO. These scores now influenced not only loans but also insurance, rentals, and other financial decisions. Python simulations can recreate this scoring system, showing how payment history, debt ratio, credit age, and types of credit impact scores. Even a single late payment can dramatically reduce a score, emphasizing the importance of responsible financial behavior. UltraFICO allowed consumers to boost their scores using positive banking behavior. Competitor Vantage Score appeared in 2006, offering alternatives to traditional FICO scoring. Yet, 90% of top lenders continued using FICO. These scores now influenced not only loans but also insurance, rentals, and other financial decisions. Python simulations can recreate this scoring system, showing how payment history, debt ratio, credit age, and types of credit impact scores. Even a single late payment can dramatically reduce a score, emphasizing the importance of responsible financial behavior. By simulating credit scores in Python, learners can see how on-time payments, debt ratios, and credit history length affect results. Historical data shows rapid FICO adoption in the 1990s. FICO 8, launched in 2008, improved fairness by ignoring small debts, while FICO 10T tracked trends for better predictions. UltraFICO rewards positive banking behavior. VantageScore emerged as a competitor in 2006, but FICO remains dominant. Understanding these tools empowers consumers to make smarter financial decisions and maintain a healthy score over time. Let's explore how Python can be used to simulate FICO scores. By creating a function that takes payment history, debt ratio, credit age, new credit, and types of credit as inputs, we can calculate a score from 300 to 850. Testing the function with perfect data may yield a score around 780, while a single late payment can drop it to 620. Python visualizations help learners understand how small changes in behavior impact scores. FICO scoring models have evolved from simple punch card computers to sophisticated AI algorithms. By 1981, general-purpose FICO scores were widely adopted, and by 1989, they were integrated into Equifax reports. This data-driven approach transformed lending practices. The 1990s saw rapid nationwide adoption of FICO. Housing booms and economic growth increased the need for fast, objective lending decisions. Congress's 2003 mandate for free annual reports increased consumer awareness and adoption. FICO 8 ignored small debts, while FICO 10T tracked monthly trends for more accurate predictions. Ultra FICO rewards responsible banking behavior. Modern scoring considers both historical and current financial behavior, though debates over fairness remain. Python simulations allow learners to visualize these trends, understand scoring nuances, and explore how individual actions impact creditworthiness in the real world. Today, credit scores influence almost every part of financial life. They affect loan approvals, interest rates, insurance premiums, and even rental applications. Understanding your credit score helps you make smarter financial choices. Regular monitoring is important because errors and fraud can negatively impact your score. Free annual credit reports allow consumers to review their data and correct mistakes. Credit scores improve gradually with on-time payments and responsible credit use, but they can drop quickly due to late payments or high debt. Even small financial behaviors, like paying bills late once, can have long-term effects. This is why awareness and consistency are key to maintaining a healthy credit profile. Banks and lenders rely on credit scores to manage risk while making fast decisions. Python simulations help visualize how scores change over time based on behavior. On-time payments steadily increase scores, while missed payments reduce them sharply. Financial literacy plays a crucial role in avoiding common credit mistakes. By understanding how scores work and using tools to track progress, consumers can protect their financial future. Credit scoring is not just a number, it is a reflection of habits, discipline, and long-term financial behavior. Credit scores affect millions of people every single day. From buying a home to renting an apartment or getting insurance, these numbers play a major role. Over time, credit scoring models have evolved from simple calculations into advanced systems using detailed financial data. Modern scores consider not only whether you pay on time, but also how your balances change month by month. Regularly checking your credit score helps you stay aware of your financial standing. It also allows you to spot errors early and take action before problems grow. Responsible credit behavior, such as paying bills on time and keeping debt low, remains the foundation of a strong credit profile. Tools like Python make it easier to understand how credit scores work. By simulating different scenarios, users can see how late payments, rising balances, or improved habits affect their scores. Free credit reports empower consumers to stay informed and protect themselves from fraud. As scoring models become more advanced, education becomes even more important. Understanding how credit scores work gives people control, confidence, and the ability to make better long-term financial decisions. Tools like Python make it easier to understand how credit scores work. By simulating different scenarios, users can see how late payments, rising balances, or improved habits affect their scores. Free credit reports empower consumers to stay informed and protect themselves from fraud. As scoring models become more advanced, education becomes even more important. Understanding how credit scores work gives people control, confidence, and the ability to make better long-term financial decisions. From 1956 to today, credit scoring has completely transformed the financial world. What started as an idea using punch card computers now influences trillions of dollars in lending decisions. Credit scores help banks make faster and more consistent choices, but they also affect everyday people in powerful ways. Understanding your credit score is no longer optional, it is essential. These three-digit numbers reflect your financial behavior over time, not just a single moment. With better awareness, people can take control of their credit, avoid costly mistakes, and plan for the future. Education and monitoring are the first steps toward financial stability and confidence. Today, tools like Python allow anyone to explore credit scoring through simulations and data visualization. Small changes, such as paying on time or reducing debt, can create meaningful improvements over time. While scoring models continue to evolve, the core principles remain the same. Responsible habits lead to stronger scores. By understanding the system, tracking progress, and making smart choices, anyone can improve their credit profile and navigate the modern financial world with confidence.